Welcome to The Long and the Short, a show where you can expect an honest take on trading, something you won't hear elsewhere. I'm your host, Sandeep Rao. In our last episode, we explored the limited downside Nifty strategy and how it closely resembles structured products, often referred to as market-linked debentures as well. Today, we turn to a fascinating market anomaly that has been observed and documented for nearly 4 decades. The turn of the month effect, commonly abbreviated as TOM or TOTM. I have a particular fascination with such market anomalies. Tracking them over time reveals a great deal about market structure, investor behavior, and even the products built on top of them, especially when they work and more importantly, when they don't. So without further ado, let's get started. As I often do, let's begin with the origins. In the 1980s, the idea of efficient market hypothesis, which I've touched upon in episodes 3 and 8 of The Long and Short, was coming under increasing scrutiny. Many researchers began actively searching for market anomalies, hoping to gather empirical evidence that markets are not perfectly efficient, at least over certain time horizons. One such researcher was Robert Andrew Ariel. While pursuing his PhD in finance at MIT, he focused on what are known as seasonality patterns in stock prices. In his landmark 1987 paper, A Monthly Effect in Stock Returns, published in the Journal of Financial Economics, Ariel was the first to formally document what we now call the turn of the month effect. He showed that US equity returns are heavily concentrated around the turn of the month, specifically the last trading day of the previous month and roughly the first 9 trading days of the current month. Together, these days account for virtually all positive market returns, while returns during the second half of the month are statistically indistinguishable from zero. Crucially, this was not random noise. The effect was statistically significant and explained a meaningful portion of the long-term equity returns. Even more importantly, it proved to be robust across both market cap-weighted and equal-weighted indices, indicating that it was not merely a small stock phenomena but a broad market-wide pattern. In the coming year, Joseph Lakonishok and Smidt explained whether well-known calendar anomalies in stock returns are genuine or merely statistical artifacts by analyzing US equity market data over an unusually long horizon, from 1897 to 1986 using the Dow Jones Industrial Average. They are the ones who formally identified and named the turn of the month effect, showing that stock returns are disproportionately high during the few trading days surrounding the change of the calendar month, typically the last trading day of the previous month and the first 3 trading days of the new month. By using nearly a century of data, the paper decisively ruled out data mining as an explanation and explains the TOM effect as a foundational anomaly. Now, moving to the question as to why does this effect exist in the first place? Researchers have proposed multiple possible causes. One is the payday hypothesis. Salaries, dividends, interest payments, and pensions are concentrated near month end. This creates temporary excess investable liquidity, which is deployed into equities at turn of the month, pushing prices up. Now, some researchers have tested this hypothesis by looking at the exchange volume data and have rejected it. Then we have risk-based explanations, that is, investors demand high compensation for risk at the month end due to rebalancing and other macro risk uncertainty. This hypothesis again has been rejected as the volatility at the turn of the month is more often than not lower. Now, what remains? Well, if you go by the 2008 paper Equity Returns at the Turn of the Month by McConnell Xu's central conclusion, they say turn of the month is an extremely robust and global anomaly that is not explained by liquidity, risk, size, seasonality, or trading volume. And therefore, the persistent peculiarity in the returns remains a puzzle in search of an answer. What a puzzle indeed. While TOTM's cause remains unexplained, it still continues to show some edge. What I would do now is to present a few backtests across a couple of indexes and stocks to see how robust and consistent this anomaly is. I have run the test on the past 10 years of data. Here's a brief of the hypothesis that I tested. Before I go further, all the prices that I've considered are close prices. The first hypothesis is what I call extended TOTM. The entry rule is go long at the close of the fifth last trading day of the month. For example, for November 2025, fifth last trading day would be 24th November 2025. The exit rule here is to exit the position at the close of the third trading day of the following month, which means a holding period of approximately 7 trading days per month. To give you an example of the third trading day of the following month, for December 2025, it will be 3rd of December. The second hypothesis is what I have called tight TOTM. The entry rules for it is we go long at the close of the last trading day of the month and exit the position at the close of the third trading day of the following month. The holding period is approximately 4 trading days per month for this one. I test these hypotheses across 5 instruments: Nifty, Bank Nifty indexes, Reliance and HDFC Bank stocks, and SPY, which is an ETF tracking the SPX or S&P 500 index. Let's start with Nifty. What you see on the chart are the equity and drawdown curves of the 2 versions of TOTM that I spoke about, extended and tight. One important thing that you need to remember when you're looking at the charts and the next set of tables that I show is that all results are shown using NAV normalized returns and hence no starting capital or leverage is assumed. Total percentage return on a NAV equity curve shows how a notional capital of 1 grows over time through compounding. A return of 41.7% simply means 1 became 1.417 by following this strategy. It is not the sum of trade returns or dependent on the index level. It represents pure capital growth from the equity curve. Talking about leverage, since the performance metrics presented are without any leverage, if you want to simulate to see how the strategy would perform with, let's say, 2x leverage, you would have to double both the returns and the drawdown and you would get the value. Lastly, these returns are compounded trade by trade and are pre-costs. Let's look at the trade stats. As evident, there is a massive difference between the extended and tight TOTM. So it looks like the turn of the month effect is more pronounced towards the end of the month instead of the beginning of the month, at least on Nifty. Almost all the metrics are better with the extended logic, be it win rate or average win size, median PNL or max drawdown. Have a look at the return to max drawdown ratio. Extended TOTM wins hands down. Expectancy is the average percentage return per trade. For extended TOTM, each trade returns about 0.82% on an average, which compounds over time in the equity curve. Do note that Sharpe ratio here is trade scale, meaning it's computed on per trade returns annualized by trade frequency, not on daily returns. One more thing to remember is that this strategy is in trade for roughly 96 days out of about 250 trading days in a year. That's around 40% of time. In other words, the capital is logged in only for 40% of the year. As always, a disclaimer. What I'm sharing with you is just a hypothesis, not a recommendation to trade. The purpose of this is to highlight an existing anomaly. Obviously, to make it tradable, one would need to tighten the strategy with some kind of a stop loss, filters, and so on. And also you would have to make a choice in terms of the tradable instruments, whether it be futures or options. Now let's drill down year-wise to see if the anomaly plays out consistently or is it based on the general market trend. What you see in this table is A, Nifty calendar year points. For example, if Nifty went from 20,000 to 21,000 in a calendar year, the points would be plus 1,000. Next, we look at the points made by the strategy that year by the TOTM extended strategy. That way, we understand how much of the total yearly returns are captured by the TOTM strategy. As you can see, from 2015 to 2019, it's only 2017 that looks good. And that's because it was a linear uptrending year. 2018 and 2019, the performance takes a pause. Then we have the 2020 to 2023 period where the strategy outperformed the index. Now again, in a lull from 2024 to 2025. To me, it looks like it's a function of the larger market trend, and that makes me think if we could have a broader trend filter for this. Let me know in the comments what could be that filter. I'll test it out. If you look at it, the magic starts from 2020 onwards. But me being me, I wondered as to what happened in the years like 2019 and 2025, where the calendar years did have some gains, but TOTM extended didn't seem to perform. To figure that out, I created 3 segments to drill down further. The first segment is the existing extended TOTM. The next segment that I define is what I call the early segment that enters on the 4th trading day and exits on the 9th trading day of the month. And then I created the third segment which enters on the 10th trading day of the month and exits on the 6th last trading day of the month. Now look at the table. The years 2019 and 2025, do you see a similar pattern? No returns from extended TOTM and most of the returns came from the mid-month segment. Likewise, in 2018, a large part of the returns came from the early segment. But if you look at the median returns of the segment, nothing comes anywhere close to the extended TOTM. What that tells us is that the TOTM is the strongest anomaly in the existing dataset. Yes, there will be years of underperformance, but over many years that should even out. Next, let's look at Bank Nifty to see how it performs. The equity and the drawdown chart is similar in structure. If you look closer, between 2015 and 2020, Bank Nifty was pretty much flat compared to Nifty. Let's now look at the performance metrics. While in absolute terms, extended TOTM on Bank Nifty does better, but it comes with a higher drawdown. Hence, the return to max drawdown is lesser than that of Nifty's, which is at 15.1. Now let's look at year-wise TOTM points. Similar structure to Nifty, even though Bank Nifty did well on a calendar year basis, TOTM miserably failed. What could be the reason? Maybe something similar to what we saw with Nifty? You may want to test it out and check. If you do let me know in the comments. Next, let's see if the pattern plays out on stocks. I have chosen Reliance and HDFC Bank in the sample. Let's look at Reliance. While 2017 saw a spike in the performance, post that till 2021 the performance was almost flat. Then 2021 to mid-2024 was a long period of significant performance. Now let's look at the performance metrics. While the extended TOTM may look good absolute performance-wise, it still doesn't beat Nifty on the return to max drawdown ratio, 9.98 versus 15.1. Next, let's look at HDFC Bank. Visibly much smoother equity curve compared to Reliance. Also, except for 2019 to early 2020 period, this one has largely gone up. The smooth performance also reflects in a slightly better risk to max drawdown, 12.1 compared to Bank Nifty's 10.28. Lastly, out of sheer curiosity, I run the same logic on SPY. Interestingly, the equity curve structure is quite similar to Nifty's extended TOTM strategy. Barring the 2018 to 2019 underperformance in Nifty, which SPY did not experience. Also, SPY seems to be more volatile than Nifty with a low single-digit returns to max drawdown ratio of 7.4 versus Nifty's 15.1. In summary, we looked at two versions of the turn of the month effect, that is TOTM extended and TOTM tight. Extended version consistently looked better across indexes, stocks and SPY. But I'm sure you all would ask, all this is good Sandeep uncle, what do I do next? Well, what I shared with you is a possible direction of where the treasure exists. You would need to do some work to dig it out. Okay, on a serious note, now that you have a sense of what the TOTM effect is and the variables that could be used to figure where the edge lies, you may want to play with the structure more with additional parameters like a trend filter or a stop loss, fixed or trailing. I'm sure you would find many such patterns that work. So that brings us to the end of this episode on TOTM, that is turn of the month effect. I hope you found this episode valuable and interesting. Do share your questions, thoughts and feedback in the comments. I'll do my best to respond. Thank you for watching and see you in the next one.